Yes, thank you, Ben, for the kind introduction. Thank you also for organizing this whole event. I think you did a marvelous job there. Thank you all for being here. My talk, as Ben said, is called Accounting, Money and Banking in Terms of Law, so I will sort of try to take on the ball that Wolfgang played to me in connecting law and accounting. And please allow me to briefly talk a bit about what ANEP does, or what we attempt to do, from a slightly different angle. You will see quite a few slides that also Wolfgang used, but from a different angle. So this is the core, in a certain sense, the core of our approach to what we try to do. Because what we have found is that people in different disciplines at the universities, disciplined scholars, use terms and concepts in different ways. So they sometimes use the same character strings, but with totally different meanings. So they use different concepts. And one example for that would be in law, the concept of property, which we will get into in a bit, is something completely different from what an economist would mean if he says the same term, the same characteristic of property. So, and what we try to do is we try to basically create an integrating conceptual framework that is specifically integrating law, accounting, and macroeconomics, where, as an example, daily business practice integrates law and accounting, but a businessman is not interested in the macroeconomic perspective. They care about their individual business interests. There are different approaches in these intersections. Within law, you could also put legal anthropology. Wolfgang has mentioned that. So what I will do in my talk, I will start with law briefly, and then move over to accounting, and finally to macroeconomics, basically emphasizing these interfaces. This is the content of my talk. I will give a brief overview, accounting in terms of law, just as a picture, and you have seen that before. Then I will go into what is called stocks, and we'll develop that step by step, proceeding with money, quote unquote. So this would be one of those character strings that are very readily used, but are rarely concisely defined. So we have Johannes Schmidt here. He loves to tell his students, don't say money, don't say capital, don't say saving, say what you mean. So we will dig into this concept that flies under the label money, and try to be a little bit more precise here in differentiating commodity means of payment and credit means of payment. Then even digging deeper into paying, 3 different ways of paying that can also be very clearly connected to law. Then coming from stocks, going to how changes in stocks happen, flows of monetary wealth, and then a critical division in monetary theory that we term the bipartite division of monetary theory, that is going to be sort of the playing the ball to Thomas and Johannes tomorrow, because the whole business cycle theory, the whole macroeconomic ex ante theory is based on this very division that, for example, the flow of funds accounts of Morris Copeland don't have systematically. So I show you this picture to connect to what Wolfgang has just done. This is, if you will, family or kinship. So if you are within the very nearest kinship circle, anthropologists call it a generalized reciprocity, positive reciprocity. You know these people very well, you're very directly connected to them, but the further out you go, the less known these people are. You proceed through balanced reciprocity into negative reciprocity, and here outside, people are rather strangers. This is very different from this framework here. This would be Gesellschaft, society, and this would be Gemeinschaft, community. And so the transition from Gemeinschaft through state and modernization, individualization, being able to just simply change the town where you live in, sign a rental contract, sign a labor contract, is not a given. Specifically, even for women in the West, this only developed in the 20th century. So this is not a given, but it's part of a transition from community to society. And of course, there is this conflict, this intersection. Without a public sphere, here there is no public sphere. There is no res publica. There are no public affairs. If there are no public affairs, you can't use resources from public affairs and use them privately because there are no public affairs. So corruption needs a state, but in the idealized perfect state, there is no corruption, which is not achievable, right? So this will always be there. And of course, in the other direction, we have repatrimonialization. So this would be, you sort of have a state, but you sort of, you choose your cousin over a qualified person in administration. Then we would be talking about repatrimonialization. So what we do now is we focus on that. We just take that sort of for granted if we look into accounting. And this is accounting in terms of Roman law. You have seen this slide before. We have the dialectic conflict between public law and private law based on contract and consent, public law based on order and command. And basically, what the Republican, democratic republic, sometimes only loosely called democracy, but always implying a state, tries to mediate this by constitutional law. And then there is this story of the social contract, of course. But in actual history, people never signed these social contracts. So the actual history of the state emergence is different. Did I say 15 or 50?
15?
Did I say 15?
You meant 50.
I meant 50.
Oh,
sorry.
That's so different. Go for it.
Right. So the conflict is mediated, but it doesn't go away. The conflict is there and produces these cycles that Hofer has shown us. So now, zooming further into accounting, we look at this law accounting connection. Wolfgang has also shown you that, but I want to emphasize that the stocks, okay, so if you're a lawyer and you've never looked at accounting, most accounting concepts are actually legal concepts. There's only these balancing items, claims plus property rights minus obligations equals the net worth. Only these balancing items are original accounting terms. And there is another balance I want to emphasize here, and I am going into more detail on that, the so-called net financial position. That would be claims minus obligations. Okay, it's a different balance, but also a balancing item.
So, just a question
Yes.
here in your world. So the net financial positions would net out to zero in the aggregate,
Absolutely, and I wish.
but not the net worth.
Net worth won't. No,
Yeah.
net worth doesn't.
Exactly.
So, and now we zoom in on a specific stock. Okay, and that specific stock we call property rights. Sometimes by economists only called real assets, but what is real about these real assets? So let's assume we have two persons and a thing, a house. And these two persons make the following statements. The one says, I legally own the house, and the other says, I rightfully live here. How does that work? Well, it's actually rather standard because we have an owner and a tenant here. The tenant lives in the house, he pays rent to the owner, and the owner, well, he's the owner of the house, but he doesn't live here. He doesn't live in the house. They do have a rental contract that provides the tenant with a right to live in the house and an obligation to pay the owner the rent. The owner himself, if he does use double entry bookkeeping, keeps track of his position of absentee ownership like this. There's a property right conceptualized here from the house to the owner, and he keeps track of his property as an asset on the asset side of his balance sheet, creating here the equivalent net worth. So it's not the house that is on a balance sheet. Never ever has anything ever been put on a balance sheet, but the right to the thing gets put on the balance sheet. So, and then we can go into more details. The owner legally owns the house. The tenant, on the other hand, he possesses the house. He can touch the house. So everything you can touch, you can be sure it's not property. Property is a concept. The property right is an asset. The thing itself is not an asset. The thing itself is material and concrete. It has use value. It's physical. The asset is immaterial, abstract. It's money denominated. It has an exchange value, and in that sense is metaphysical. For lawyers, really, this is very, very basic stuff. But not all of us are lawyers, so it's good to keep these concepts in mind, or rather, acknowledging that there is a reason why lawyers conceptualize property this way. So, let's assume we have a lot of things and even ideas, immaterial things, and we also, so these are called by lawyers the first order objects of laws, things, ideas, services. So we're talking about things you can touch or maybe not touch, like ideas or services, but still it's the world of possessing and using tangible and intangible things and ideas. We're talking about production here, we're talking about industry, or Aristotle would have called it oikonomia. We're talking about engineering and technology and all of that. We're talking about specific use values, and now let's assume we have persons that own some of these things. And we show it like this. Also again, this person would be the owner of this house. Maybe he lives there, maybe he doesn't, we don't know. But if this person would have a balance sheet, the property right of this house would be on the person's balance sheet. And then of course these people not only have property rights, but they also can have claims and obligations towards each other, contractual relations. And therefore, this world where all of that's happening, contracts, property rights, is a completely different world from the world of things and possession. So, for example, right now, I do possess this presenter here, but I'm not the owner. In fact, I don't even know the owner. Probably BI. Oh, it's Ben's. Okay. So this world is the world of second-order objects of law. It's the world of rights and obligations. It's the world of abstract monetary exchange values. And it's the world of business, finance. Aristotle would have called it grammatistike. It's the world of law and accounting. It's a world that you cannot touch. It's a conceptual world. And of course, this world, to have any effect in this world, needs state and law enforcement. There's sort of the connection there. And to be very specific, this world is a historically specific world. It's not universal. It's Roman. It's not human. So here's a quote from Karl Lorenz, who's a very well-known legal scholar in Germany. From the perspective of law, we must clearly and precisely distinguish things as first-order objects of law from rights as second-order objects of law. The objects of the property rights belonging to someone's assets do not represent the assets. The assets consist of the property rights in the things or objects, not in the things themselves, and in the creditor's claims, not in the objects which can eventually be legally claimed on their basis. So this is, for lawyers, this is very normal. They deal with that every day, but we as ordinary citizens living within European Western civilization, we're sort of kind of vulgar lawyers, you know. We use legal concepts, but actually we don't go into the details of what they actually mean. But we believe we have to dig into these legal concepts if we want to understand this European Western civilization. And here is Wesley Hofer, whose picture I have seem to have lost. Okay. Who is even more precise. So I showed you the property right as a relation from the owner to the thing, but in actuality, it's a social relation in the following sense. The owner holds the property right as a right of exclusion against everybody else. So it's a relationship that he has as the owner towards all other persons. And Wesley Hofer calls that a multiple right. It's a right vis-a-vis all others who hold the duties to respect the right, and the state will enforce it. A claim, on the other hand, is a unital right. It would be a right vis-a-vis one other's legal obligation, one other's duty. So, we could say, pointedly, financial accounting deals with keeping track of immaterial, money-denominated, triangular relations, because the state is always involved, between free and equal legal persons and an enforcing state. That is why it's triangular. As if they were things, but they're not.
Nice definition for economics.
Quick summary of what we've covered so far. We have historically specific core distinctions in Roman law. The one is private versus public law, which are in constant conflict. And the other is the distinction between things as first-order objects of law vis-a-vis rights as second-order objects of law. Going into more details of stocks. This is the overview picture, and let's now build it from the ground up. So a balance sheet has always two sides. It has the rights side or assets side and the liabilities side. We put the legal terms, rights and obligations plus net worth, and let's assume that you are a book publisher and you hold certain claims, banknotes, bank deposit, accounts receivable. These are all claims against different legal persons. So a banknote would be a claim against the central bank, bank deposit would be a claim against the bank, and accounts receivable, maybe you have already sold some books to a wholesaler and he still has to pay you. So this would make 1,000. And then, maybe you had to order these books from a printer, let's say, and maybe also you need to pay the guy who wrote the book. So you have some accounts payable, these are obligations in the future. And so a balance sheet has is defined as being equal on both sides. And how does that work? When clearly obligations and claims in this case, they can be different, and they most of the time are. This is done by balancing items. And so if I would pay, let's say, 100 of these 600, my accounts payable would shrink and the balancing item would increase in the same amount. It's the definition of double entry bookkeeping. You always do both entries, and hence the balancing item basically provides for that. We call this balancing item between claims and obligations the net financial position. That would be 400 in this case. We don't have any property rights yet. If we added property rights, let's say you have already, some books on your asset side, then again we need a balancing item, and in this case, this balancing item is called the net worth. Please note, it's property rights plus claims minus obligations equals the net worth. So the balancing item is not a stock in the sense of these other stocks, but still you could, you could say claims minus obligations. There is this other balancing item implicitly still there. And this realization brings us to the equation that property rights plus your net financial positions precisely equals your net worth. this is an equation that we will use tomorrow a lot, because you could say, okay, let's assume an economic agent aims to optimize his net worth in the sense that the more net worth he holds, the better off he is. And we could also assume that he has certain expectations about the future prices of property rights. Let's say these are property rights in real estate, and you imagine that real estate prices are going to go up. Then, if that is your assumption, then what do you do about your net financial position if your aim is to optimize net worth? In this sense, you would try to get rid of any net financial assets, so you would decrease your net financial position to hold as much property rights as you can, because you expect the property rights to rise in value, and that would help you to optimize your net worth in this case. Yes?
So in finance, corporate finance, you have this idea about the book value and the market value of the property rights. So you're going to go further into that, or you just assume the market value? Or?
I'm not going into this yet, but let's still postpone the question, please, because I think it's going to be more easier to address it later. So, as a summary, we have learned that assets are not things, first-order objects of law, but assets are rights, second-order objects of law. And most stocks, assets, debts, are actual legal concepts, rights and obligations, but there are some specific stocks that are genuine accounting concepts, and we call these balances. That's really sort of new. So if you're a lawyer, never have gotten in contact to accounting, you shouldn't shy away from it, because most of the stocks are actually legal concepts. But these specific stocks, the balances, you need to have a look at. And we have gotten to know now two important balances. One is the net worth. So if you're an economist, think budget constraint. And we have come to know the net financial position, which is sort of the question, do I want to be a net creditor or do I want to be a net debtor, depending on my assumptions and inclinations to optimize my net worth. Moving into money. Money in law versus non-law. Let's suppose this is the whole spectrum of stateless or failed weak state societies, communities. There people do not use means of payment, but we say they use means of barter exchange. Okay, and let's differentiate that sharply from state and law. Inside state and law, we have rights, private and public law. But not all rights are assets. There are certain rights that cannot, be sold. Your personal freedom is a right for you, and the state would defend it for you as an individual. It's not that in the European Western civilization there is sort of the head of the tribe, and it could, for example, for certain tribal reasons, order you to marry someone. He couldn't do that because you yourself as an individual have the right to personal freedom. You can't be forced, even from your relatives, to do certain things that are against the law. But these rights are not assets in that sense, that you can't sell your personal freedom. Your personal freedom ends right there. You can't sell yourself into slavery in European Western civilization. So the assets are a subset of all rights. Within this subset of money-denominated rights, of assets, is what happens what we call accounting and economics. But then again, not all assets are means of payment. Means of payment are still a further subset of assets. They are the most liquid, that's a metaphor, the most liquid assets. So if we put that on a balance sheet, we would end up with the realization that the most liquid claims, credit means of payment, think bank deposit, think banknote, are what we call credit means of payment. These are the most liquid claims, and then of course you can have other claims against, someone you delivered a book to and he still has to pay the book. Those are other claims, but they're less liquid. They are not means of payment. They're other claims. And the same is true for property rights. And in the history of money, you did have, actually until the early 1970s, you did have commodity means of payment. Think a gold coin, for example. That are property rights. A gold that shows up as an asset on your balance sheet does not show up as a liability of someone else. So it's a property right. Commodity means of payment. And then of course there are other property rights that are not that liquid. So you can't use the property right in a house as a means of payment at the grocery store. Just don't work. This is the business perspective on liquidity and accountability. So if we rearrange these stocks, so here we stuck with the categorization of property rights and claims, but the business perspective differentiates so-called current from non-current assets. They don't too much look into property rights versus claims because they don't need to look at the macroeconomy. We need that differentiation later. Therefore, they would list the means of payment, property means of payment, commodity means of payment, and credit means of payment as the most current assets, the most liquid assets, or the most shiftable assets. Or to even go further, the most eligible for collateralization. That could be another discussion. And then you have other claims, accounts receivable, other property that's still easy to sell. And then you have non-current assets, assets that you would need, say, for your production or long-term claims that are not that current. Of course, you still can sell or use as collateral these non-current assets as well. But the point is, why do business people do this? They do it because they have obligations to pay at certain dates. And so with this hierarchization of rights, we can, I think, make the connection to Perry Melling's work, to the hierarchy of money. Because a shiftable right is better in terms of liquidity shiftability than a non or less shiftable or non-liquid asset. So there is a hierarchy in rights. This doesn't mean that this shows up in the value, in the value on your balance sheet. A house in a property right in a house still may have tremendous value and add to your net worth, but in terms of the survival constraint that is about the obligations in T1, you need to have exactly as many means of payment in T1 to meet your obligations, because these obligations, these legal obligations, they are enforceable as soon as they come due, and therefore you need to meet these obligations to not be illiquid. That is what banking specifically needs to worry about. But of course, that's every single business needs to take care of that. The survival constraint binds on the level of means of payment for any business. But of course, banks are in a specific situation in the sense that they are in the liquidity provision business. So they are trying to provide liquidity for other business, for other persons, for other legal persons or natural persons, and therefore expose themselves to liquidity risk, and therefore specifically need to worry about the survival constraint, which is done on taken care of in the money markets. They get their means of payment there. So if we use the differentiations that we now have built up, we can come up with 5 subtypes of money. So if you hear the term money, the character string money, you better ask further what exactly is meant. Because we at least have 5 subtypes of quote-unquote money. here's the distinction between property rights and claims, and here's the distinction between private and public law. And in any one of these four categories, we find historically examples where people have used private property rights as means of payment. For example, tobacco in the US, in the early US, or barley, even going back to Mesopotamia, silver, privately minted coins.
Yes, it's just money. You just started out saying you should never say money. You should be more specific.
You should say what you mean.
So is this money as means of payment and
yes,
and not account? I mean, as a unit of account.
Not money of account.
So you're talking money as means of payment.
Money as means of payment, right?
Thank you.
Money as means of payment. Minted coins by the government have been used as means of payment. So these are the commodity means of payment here in private and in public law. And we also have credit means of payment. Very common today, demand deposits, credit cards, on the private side. Bills of exchange in the past, also private banknotes that we don't have anymore. And of course, on the public side, we all know the Federal Reserve notes or the notes of the Norwegian Central Bank or the European Central Bank. And there are also examples earlier in history. And then, so these are means of payment, right? And then there are means of barter exchange outside of law. And the most maybe lively example would be the dollar in dollarized weak and failed states. It's not a means of payment in the sense that we have it here conceptualized, but it's actually it's just a means of barter exchange that is produced in the jurisdiction of the US, or maybe even outside of the jurisdiction of the US. But the note itself is used much like the cigarettes were used as a quote-unquote currency in post-World War II Germany. So this would be the distinction between law and non-law, yes.
Maybe it's a stupid question. What's the difference between 1 and 5?
The difference
in this case between tobacco and cigarettes.
Yes.
What's the difference?
I don't think this is a stupid question at all. I think it's a brilliant question, really, because let's think about it. If you have a rather well-functioning and established society where people do live in this world of second-order objects of law, where this is fairly clear and established as an institution, then the tobacco that is a thing, it could be, seashells here could be a thing, or are things, and tobacco is a thing as well. But used in this sense as a means of payment is not the tobacco as a physical object, first order object of law, but what is used to fulfill the contract is the property right in the thing, in the tobacco. It's not as clear as the separation is between law and non-law, because there are weak states and failed states and all of that. And let's say early US usage of tobacco as a means of payment. How much of a well-functioning state was there in the US? So there's quite some gray area, and also here in these tribes using seashells as means of barter exchange. That didn't come out of nothing, but that was imposed as an obligation, as a tax obligation, because they knew that the seashells at the physical places where that was used as a means of barter exchange, they knew they couldn't find it there, but it was sort of brought by outside powers and requested for them to pay their taxes in these seashells. So it's not as separated as it is here, but it's a conceptual separation to then be able to meaningfully integrate the two as well in looking at actual history. So I think it's a brilliant question.
So it's based on your distinction between failed and successful states, right?
Right. It's based on the distinction between non-law and law, and that one can be quite fuzzy.
Maybe I can add something to that to clarify a little bit. Number one would be a means of payment in the sense that you can use it to actually fulfill contractual obligations that you have. In other words, that presupposes the whole concept of of contract and of credit, because you can use these means of payment to first purchase something on credit and then pay it later. Whereas in the number 5, we're just talking about exchanging goods for one another, and you don't have this framework of contract law, and therefore you also don't have a credit system, and therefore you don't have a financial system, right? You don't have transferable claims, so you still have that function of having a generalized means of exchange, but the means of payment function isn't there. And the money of account function isn't there either, because if you don't have that whole legal system, there's no need for any accounting. I mean, tribal societies, they don't even write, right? They sort of keep track in their head, I gave this to that person, and sometimes
I must object. I do think
Okay.
that your distinction between tribal and European is a little too kind of stylized and too sharp.
Yes.
But you already said that. But I'm just making the objection, just registering the objection.
Sure.
You don't need to address it.
We can discuss that. Yeah, sure.
Yes.
Just a short comment. Do you use KNAP and money as a creature of the state for this? Because it's very, very similar to his argument.
Well, so on this slide, we believe you can actually rather beautifully see the different schools and the conflicts of these schools. And KNAP would be more on the public law side, saying it's nominalism, okay, or chartalism, and we would say let's have it all. Let's have it all. Let's not fall either on the public side or on the private side, but let's grasp the hybridity of that concept.
And that's also because you have it's means of payment that you focus on rather than unit of account, I guess. Oh, we can continue.
Yes, we can. Let me. There are some slides coming, I think, for you still. So, as a summary, assets are a subset of all rights. Means of payment are the most liquid types of assets. We have credit means of payment and commodity means of payment. And the shiftability of these rights creates a hierarchy. We have 3 very different stocks. Think of them. We have means of payment. Think survival constraint. We have the net financial position. Think the question of whether I want to be a net creditor or a net debtor. And we have the net worth. Think budget constraint. And so now we go into payment a little more clearly. Let's say we have a debtor that pays a creditor. He has the possibility to use commodity means of payment. He can transfer coins that he has to the creditor and therefore cancel his obligation, and of course then also cancels the claim that the creditor A has against the debtor B. That is one way to pay. Some people, let's think Bitcoin, okay, they sort of kind of assume that this is how it should be done. This is how payment should happen. You should have something that you give. You should have a, right? They don't even say, right? You should have that means of payment to give to your creditor. But that's only one way to pay. Another way is, and that's very relevant for banking, is the offsetting of mutual claims. So the debtor B and the creditor A are also creditor and debtor vice versa. And they notice that and therefore offset these claims without transferring anything. Okay, so when Perry Melling says all banking is a swap of IOUs, he's talking about additional claims and obligations on both sides of both balance sheets between 2 legal persons. And then the offsetting would be the cancellation of claims and obligations on both sides of both balance sheets. So these are, of course, credit means of payment. The other way would also be banking related, but then the bank as the party C here, where the claim against the bank is used as a means of payment to pay the creditor A. The obligation and the claim get cancelled, and the claim against the bank is transferred to the creditor A. Here we have 3 legal persons, which would be the debtor and the creditor and the state, and here it would be 4 because it's the bank as well that is involved. So Here we have a swap of assets and a balance sheet contraction. Here we have two balance sheet contractions. That's rather counterintuitive, I think. And here again, a swap of assets and a balance sheet contraction. Three ways of paying. Now, at changes in stocks, flows of monetary wealth. We have this stock, means of payment, and if a business tracks changes in these means of payment, they're talking about receipts and payments. So the receipt that they have minus the payments in a given period equals the changes in the means of payment. Not all receipts necessarily are also revenues, which would be changes in net financial position. Revenues minus expenditures are changes in the net financial position. So if you find a central bank note on the street, which is a rather unlikely event, but nonetheless, it would be a receipt, it would be a revenue, and it would be a yield also. So there are cases where all three of these stocks change in unison, but there are also cases where you only have a receipt, but you don't have a revenue. So you keep track of these stocks separately, and I will make an example. Under the bipartite division of monetary theory. Because we can use that to separate real and purely financial transactions. Let's say we're dealing with the buying and paying of a property right in a book. So we have a retailer and a publisher, and as soon as they agree that the retailer wants to buy books from the publisher, he gets the property rights in the books and then has an obligation to pay the publisher. For the publisher, he gains a claim and loses the property in the book. Now the question, is that receipt, revenue, or yield? So receipt is change in means of payment, revenue is change in net financial position, and yield is change in net worth. Has the net worth changed here? No. Neither for the retailer nor for the publisher, because the publisher, the retailer puts the property rights of the book at the costs for him, on his balance sheet, and he has the obligation to pay. So an expansion of the balance sheet on both sides, the net worth doesn't change. Same for the publisher, he just basically swaps assets here. And the means of payment, there's no payment involved here. Yes? Question?
Wouldn't the reason the retailer buys the book from the publisher be because it's more worth for the retailer? The book is more valuable for the retailer than for the publisher.
Absolutely. But he doesn't show this net worth, thank you, Ben. He doesn't show this net worth immediately, but he would show it as soon as he sells the book on. And he is convinced he will sell the book for a higher price than he had to buy it. But he can't realize this net worth. Well, he can. It depends on the accounting.
The reason why he went into the transaction would be that he would value it higher than the publisher.
Absolutely. And it depends really on your accounting rules. If it is not possible for you to immediately realize a net worth, that's a very relevant question, and it's also sometimes this discussion of continental principles of accounting and more Anglo-Saxon principles of accounting. There are different viewpoints on this very question. Was there a question? So to make a long story short, it's changes in net financial position, because the property rights doesn't count for a net financial position, but there is an additional obligation. So the retailer's net financial position decreases, the publisher's net financial position increases. Therefore, he records that as a revenue, and the retailer records this real transaction as a expenditure. And now to paying, the publisher chooses some means of payment. We have seen different kinds of means of payment. And let's say he gets paid by bank transfer. The retailer loses means of payment and provides them to the publisher, and the obligation and claim gets cancelled. So now we have payment and receipt, but we don't have any change in a net financial position. Right? What is this net financial position? On a national state level, the net financial position is called the current account balance. And this is the cumulative current account balance from 1980 to 2008. And we see that some countries are rather dark green, so this would be Germany here, right? And then we have net debtors, like the US here is rather prominent. But the sum total is always zero on current account balances, because this is the net financial position. That's sort of a given, and we can see that if we use the sectoral balancing approach. Let's take a partial group, Germany, that holds claims against the rest of the world and against whomever, and has also obligations and property rights, and therefore a substantial net worth as a whole. We're not talking about the German state, but as a whole. And then the rest of the world, would be the complementary group that just has the vice versa position. Not, of course, in property rights, because those are independent. But claims and obligations, they add up in a closed aggregate world economy to zero. Always. That's a key here, and that is only on the level of net financial position. It is not on the level of means of payment, and it is neither on the level of net worth. That is why we need to have this bipartite division of monetary theory to have this meaningful integration. You can't do it like Morris Copeland does it with money flows, saying, okay, the source of one is the use of another agent. Source, in what way? What are we talking about? Means of payment? He says money flow, but he's not specific. So this, we believe, the Stützle approach is much more powerful here. And to be very precise, the net financial position of the partial group plus the net financial position of the complementary group is the net financial position of the aggregate, which is zero with an asterisk. And visually, you can see that the balancing item net financial position of the partial group is the exact negative of the net financial position of the complementary group. So for Germany to say, you should all do what we do, is rather inconsequential when you realize that, because it doesn't work. Not everybody can have a positive net financial position. It just doesn't work for mechanical reasons. So using Stützle's scheme, we no longer have to choose between doing macroeconomics that has no micro foundation and microeconomics that ignore macro relations. And now I ask, do you remember writing that some 22 years ago?
I think, he's right.
Because this is from Charlotte's PhD thesis from 95. So, and we very much agree with you on that. And I will skip the summary for time reasons. And thank you very much for your time and attention. And I'm looking forward to your questions now. Any questions? Yes, Ben, please.
I wanted to expand on the question raised by Knut about the changes in value, right? And could you perhaps go to the slides?
Sure.
Because there is an interesting case. You have the retailer and the publisher. You were right there. Yeah, there you go. You have the retailer and the publisher in the case of the book. But suppose that you have a publisher and the writer, the author of the book, right? When the author has a manuscript, that manuscript has zero value in accounting terms.
In accounting terms, okay.
It would be very difficult for you to say, well, my book is going to be a bestseller, so I'm going to say that I have a 1 million.
You would have a hard time to argue.
You would have a hard time. It would be very difficult, right? You shouldn't probably do that. Your accountant would tell you not to do that.
Yes.
Probably. But in the moment in which a publisher buys the rights to the manuscript, essentially creating an economic entity, right? It creates a value, then suddenly you receive essentially it could be a claim on the publisher, or it could be direct payment, or generally a claim because the payment is going to come later or some, depending on the contract.
Exactly.
Right.
Yes.
And the publisher will have the property book entry, right? And that property book entry would be economically valuable. So there is an important transformative and performative role of accounting in the generation of economic value. So these transactions are not only about netting out, but of course there are lots and lots of these type of transactions that actually create elements of the balance sheet that before did not exist in accounting terms. In physical terms, it exists.
Yes.
Would this be something along the lines of what you were arguing? Because you were saying that...
Just to add on to what you're saying, I would say that the supposed value that the retailers would assume for the book was worth for him or her would probably also affect the process between the publisher and the author.
Yeah. Yes. In the sense that, of course, the publisher wants to have a retailer and these expectations of the retailer and the idea that the retailer would have on the book would, of course, influence. I would completely agree.
Charlotte?
Can you go to the world map?
Yes.
So there are different ways of perceiving this.
Yes.
So you can say that we should all be happy that we have the US. so that we can have our surpluses. Or you can say that this is only half the story, because the really important story is that the US can have such a large negative current account, or because it has all the real wealth of the world.
Yeah,
So-
because they are in a very privileged positions and people
Because
the
their
exorbitant-
real stocks are valued high, people are willing to lend them money. So in Russia, it's not a critique of what you're saying. It's just that it gets me curious to hear about the valuation of real stocks, because this is only the monetary story. This is not what creates cycles, maybe.
It's a rather, as soon as you go on the international level, it gets rather very complex rather very quickly, because there is no world state. Okay?
But
And
you see, Mike, that you would expect the poor countries to be green and the rich countries to be black, because all the real wealth, all the production capital of the world are concentrated in the red zones.
you mean commodities, or what do you mean?
Yeah, I mean, these debts are created, backed up by some collateral, and this collateral would be, production capital, or
Yes.
nice houses, or whatever. We would not, if we did not consider the US a nation of wealth, we would not lend them all this money.
However, we're not talking about net worth here.
No, I'm
We're
sorry.
not talking
yeah,
about that.
exactly, and that's my point.
Could I
So yes, please.
maybe reply to that, because I agree with you, and I think maybe it's useful to think about the legal system and the state enforcement as something that is actually able to create economic value by creating creditworthiness. So if you have a debtor within a state that has a very reliable legal system, then you're going to be more willing to lend to him, because you know you can actually enforce the claim. You can actually make sure you get back what you lend.
Yeah.
Whereas in other countries where that is not so much the case, the creditworthiness is going to be lower, and if people within a country like that still want to be creditworthy, they need somebody else to guarantee, to take the guarantee for them. And the Western countries do that for a lot of the developing countries.
So
right?
the African countries could never be allowed to be as black as the US.
Right. Unless they had somebody else guaranteeing the payment for them. And that's
a Greece story, really.
absolutely.
What this slide doesn't show at all is what money of account are we talking about. This slide doesn't go into that at all. It basically presumes a perfectly working FX market, and then just adds up at current dates. This is the cumulative from 1980 to 2000. It doesn't say anything about the money of account. The international currency, that doesn't have an international state, but it's rather a national